Look at this chart. At this point, do you think the price will go up or down? Now imagine having a powerful tool that can answer this question for you. Welcome to Mohsen Trading. In this video, we will learn how to use the Fibonacci tool to identify key levels and make more informed price decisions. Now, let's dive into the chapters where we will explore the core concepts in detail. Chapter 1. What is Fibonacci? Chapter 2. How does the Fibonacci tool work? Chapter 3. Practical guide to Fibonacci retracement. Chapter 4. Mastering the Fibonacci Extension tool. Chapter 5. How to use Fibonacci expansion like a pro. Chapter 6. The golden zone, key Fibonacci levels explained. Chapter 7. Advanced Fibonacci settings and smart strategies. Chapter 8. Important point for all Fibonacci. What is Fibonacci? Leonardo Fibonacci was an Italian mathematician from the 12th century who introduced the famous Fibonacci sequence, a series of numbers that appears in nature, art, and financial markets. The Fibonacci sequence is a series of numbers where each number is the sum of the two preceding ones, starting from 0 and 1. These numbers are from the basics for Fibonacci retracement, extension, and expansion levels, which are widely used in technical analysis to identify key price levels. Interestingly, this sequence is not only found in financial markets, but also appears frequently in nature, such as in the growth patterns of plants, the structure of galaxies, and even the arrangement of sunflower seeds. Chapter 2. How does the Fibonacci tool work? The Fibonacci tool helps traders identify key support and resistance levels based on Fibonacci ratios. When applied to a price chart, it highlights potential reversal or continuation points, making it easier to spot market opportunities. Chapter 3. Practical guide to Fibonacci retracement. In this chapter, we covered the definition and practical guide to using the Fibonacci retracement. After activating the Fibonacci tool and placing it on the chart, make sure to adjust the settings correctly, as shown with the arrows. Once these levels are set, they will help you identify key support and resistance zones. In the upcoming sections of the video, we will demonstrate step-by-step examples of how these retracement levels work in real-world chart analysis. To use the Fibonacci retracement tool, we first need to click on the beginning of the impulse move, first click, and then click on the end of the impulse move, second click. This allows us to draw Fibonacci retracement levels to identify the potential end of the corrective wave. As shown in the image, in the bullish example, the price reached the 50% Fibonacci level, react and reversed. We are waiting for the price to react at any of these levels. In the bearish retracement, we click first at the start of the downward move and second at the end of the impulse move to draw the Fibonacci levels so we can identify where the corrective wave reacts and reverses. As seen here, the price reacted at the 61.8% level and reversed. The 61.8% level is very important in Fibonacci analysis and is often referred to as the golden ratio. As you can see, we have used the Fibonacci retracement tool to identify the end of the corrective move. The first click was placed at the beginning of the impulse move and the second click at the end. As you can see, the price precisely completed its correction at the 61.8% level and reversed from this area. In a bearish move, as you can see, we have applied the Fibonacci retracement tool to identify the end of the corrective move. The price reacted precisely between the 61.8% and 78.6% levels and reversed from there. Given the number of touches, it is clear that this level acted as a resistance leading to the price reversal. Chapter 4. Mastering the Fibonacci Extension tool. We use the Fibonacci Extension tool to determine price targets. This time, instead of clicking on the impulse move, we applied the tool to the corrective move. The first click is placed at the beginning of the correction and the second click at the end of the correction. This tool provides levels such as 113%, 127%, 161.8%, 200, which we can use to set price targets. The numbers you see in this image or the Fibonacci ratios, where do they come from? If we consider X as the corrective move and place the ratios 0.382, 0.5, 0.618 and 0.786 on one side of X. Dividing 1 by each of these ratios gives us the corresponding extension levels. 2.618, 2.272, 1.618 and 1.272. These numbers represent our Fibonacci extensions which are used as Fibonacci ratios. In this example, you can see that in a bearish move, the price extended to the 1.618 level, allowing us to determine a price target using these ratios. The key point is that in all Fibonacci tools, the overlap of multiple Fibonacci levels is crucial. The more overlap there is, the more significant the level becomes. Therefore, price targets are determined using multiple Fibonacci levels, not just a single one. Ultimately, we learn to apply these tools within patterns and structures. As you can see on the chart, to determine the price target, we use the same retracement tool we introduced earlier. However, this time we apply it to the corrective move. The first click is placed at the beginning of the corrective move and the second click at its end. This allows us to identify the price target based on Fibonacci extension levels. As we observe, the price has beautifully reacted to the 1.618 level within a bullish structure. In this downward move, as you can see, we have an impulse leg followed by a corrective leg. To determine the price target, we can use the Fibonacci extension tool. The first click goes at the beginning of the corrective leg, and the second click goes at the end of the corrective leg. Using the Fibonacci extension tool, we can beautifully determine the price target. As shown, when the price reached the 1.618 level, it reacted and the target was clearly identified. Chapter 5. How to use Fibonacci expansion like a pro. In this chapter, which discusses how to use Fibonacci expansion. It's important to note that this tool is a scaling tool used for modeling and analyzing market moves. To use Fibonacci expansion, we first use the trend-based Fib extension. We first use the tools to fully understand the expansion. This is because in future videos, we will use these tools correctly within harmonic patterns and Elliott structures. The Fibonacci expansion tool is a three-click tool used for modeling price moves. The first click is on point A, the second click on point B, and the third click on point C to model the AB move. As you can see in the image, the key Fibonacci expansion levels are 100%, 161.8%, 200%, 261.8%. In a bearish scenario, the first click is on point A, the second on point B, and the third on point C to model the AB move after point C. As we have mentioned before, Fibonacci levels alone won't work by themselves. They need to be used in conjunction with other Fibonacci tools like retracement and expansions. When these Fibonacci levels overlap well. For example, within a harmonic pattern, that's when the overlapping Fibonacci levels become significant for us. Therefore, Fibonacci tools should be used within a defined structure and pattern, not on their own. As we can see in the chart, the first click is on the beginning of the price move. The second click is on the end of the price move. And the third click is on the end of the correction move. This way, the price move will be modeled and as you can see, the price react at the 100% level and then reacted again at the 161.8 level. On the USD-JPY chart, as we can see on the daily time frame, the first click is on the beginning of the downward price move. The second click is on the end of the downward price move. And the third click is on the end of the correction move. The price beautifully reached the 1.618 level and showed a reaction there. Chapter 6. The Golden Zone. Key Fibonacci levels explained. The golden zone refers to the key Fibonacci level of 61.8%, known for indicating potential reversal or continuation points in the market. As seen in the EUR/USD chart on the 5 minutes time frame, we have a price movement. When we use Fibonacci retracement to determine the end of the correction after the movement, as you can see, the price beautifully reacts to the 61.8 level, our golden zone, and then reverses from there. Later, in a bearish movement, when we apply the price retracement again, the price reacts to the same golden zone level, 61.8. forming a resistance level with the price reaction. From there, the end of the correction is clearly defined and the price reverses. Therefore, this level will be extremely important for us. Chapter 7. Advanced Fibonacci Settings and Smart Strategies. In the EUR/USD chart on the 5 minutes time frame, we identified a movement and applied Fibonacci retracement to pinpoint the end of the corrective wave. The price reacted beautifully at the 50% level, which based on previous price action create a support zone. We placed our entry above the bullish candlestick and set the stop loss below the support level The target price was set at the resistance level or the highest price point in the structure. As a result, the price reached the target perfectly. The combination of Fibonacci with support and resistance formed a solid strategy for us. In the EUR/USD chart, on the 5 minutes time frame, we identified a movement and used Fibonacci retracement to pinpoint the end of the corrective wave. As we can see, the price reacted beautifully at the 0.618 golden zone level. After this, a doji candle formed signaling a potential reversal. We placed an entry order above the doji candle and set the stop loss below the candle or below the golden zone level. The target price was set at the highest point of the previous movement, which was the resistance level. As you can see, the combination of Fibonacci and candlestick patterns provided a solid strategy for entry, stop, and target points. In the EUR/USD chart on the 5 minutes time frame, during a certain movement, we used Fibonacci retracement to accurately identify the end of the corrective wave at the 0.786 level. At the same time, a positive divergence was observed at this level. We placed our entry above the last candle and set the stop loss just below the 0.786 level. The target price was set at the highest price point formed during the movement or the resistance level. As expected, the price reached the target beautifully. The combination of Fibonacci and MACD provided a solid strategy that is clearly visible here. If you want a more complete guide on MACD, make sure to check out the part 1 and part 2 videos, which I have linked in the top corner of the screen. Chapter 8. Important point for all Fibonacci. Fibonacci is a tool for confirmation. Fibonacci is not a predictive tool on its own, but rather a tool for confirming price action and supporting other technical analysis methods. Context matters. The success of Fibonacci levels depends on the context in which they are applied, such as trend direction, time frames, and market conditions. Combining Fibonacci with other indicators. Using Fibonacci in combination with other indicators and patterns enhances its effectiveness and reliability in trading decisions. We do not use the Fibonacci tool in isolation or as a standalone tool. Instead, by learning and using it properly, we apply it within a specific pattern, structure, or framework such as harmonic patterns and Elliott waves. Fibonacci is most effective when multiple Fibonacci levels overlap. This overlap creates strong zones that are significant for us. In the future, with harmonic patterns and Elliott waves, we will use Fibonacci to identify key reversal zones based on these overlaps. So stay with us, as I will soon release full videos covering all types of harmonic patterns and a complete Elliott wave tutorial. Make sure to subscribe and turn on the notification bell.